Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. European futures point higher. Traders brace, though, for market volatility in a busy week for data from the US, UK, Japan and China. Investors will eye key inflation data this week. Bloomberg sees US CPI coming in soft, while Bloomberg estimates that unemployment will rise and the job market will cool. Plus, Kyiv accuses Russia of starting a fire at Europe's largest nuclear power plant. This as Ukrainian troops continue to hold ground gained during a surprise incursion into Russia.
Japan is closed today, which makes things a little confusing first thing. We'll wait and see how US Treasuries trade, but at the moment futures are pointing positive. Keep an eye on what is happening with the currency markets. Has that carry trade completely unwound? We will find out how much more unwinding we need to deliver this week. But basically, so far, so good. Feels like a very different position to this time last week. The countdown to the opening trade starts right now. Monday the 12th, good morning. Feels like a slightly different start to the week to this time last week. This time last week, the market was preparing to hit the panic button. This week feels maybe at least we are going to see a calmer start. But is there potential turbulence ahead? We've got US CPI still to work our way through. We've got Walmart numbers still coming. We've got Home Depot still to come. The week after that actually delivers Jackson Hole and Nvidia. So the next couple of weeks, in some ways, do have things that we need to be watching out for. The question is, are they going to be enough to generate a big VIX spike like we saw this time last week, Anna?
Well, that was quite epic, wasn't it? That VIX spike. I mean, you had to go back decades to find something like it. So you know, maybe not might be the answer, but I mean, you'd be brave to call it that way, given the way that the markets are setting themselves up for what is a really busy week. Let's talk about the week ahead then, Guy. We've got, of course, US CPI, and that's bound to be the headline for many people. And I think Tom was talking about this at the end of the last hour. Traders are positioning for a move on the S&P of 1.2% either way for during Wednesday's CPI sort of aftermath. That's according to Citi. So that's going to be the big data point of the week. But then, aside from that, there are going to be data points coming in on lots of different global stories. So there's the UK side. There's also the China growth story. We get a lot of data out of China and GDP out of Japan. And given the focus we've had on Japan, that could also be interesting.
Are any of those events going to be enough to freak this market out, is the question. When's the next story that we need to really watch out for that could generate some really significant volatility? CPI maybe, but Jackson Hole. So CPI and Jackson Hole feel like they're kind of one and the same, in as much as you get a CPI print that allows Jackson Hole maybe to point towards a rate cut in September.
That would be the smooth path ahead, wouldn't it, I suppose? But there's the possibility that doesn't happen, to your point. And I feel it's interesting that in this very quiet market period where many people are on vacation and where we don't have a huge amount of volume going through, we have such important data points to hit. Yes, CPI this week, but as you say, Jackson Hole the following week, Nvidia numbers. It seems as if you won't at all be able to relax during August, given what is coming.
No.
Sorry, everyone.
We're terribly sorry. That's the real headline for the morning. You are not allowed to relax, according to Anna. What did we learn last week, though? Let's just think about last week. We've already referenced that VIX spike, so let's kind of talk about what we learned last week. I think what we learned last week from that VIX spike, which was extreme and in many ways may have been too extreme, is that the market is clearly scared of a recession. The market is really scared of a recession. And I think that growth scare at the beginning of last week clearly showed just how kind of out of position in some ways traders are. The other thing I think we learned last week is, and maybe over the last few weeks maybe, is that big tech is not the sort of safe harbour that maybe we thought it was. That actually bonds are beginning to play that role. And it's going to be interesting to see whether bonds actually continue down that road and continue to provide that ballast in people's portfolios. Yeah, exactly. And we've got quite a lot of reporting out over the weekend talking about bonds being back. You know, I feel like we've maybe written those stories before and we've asked those questions, and we will continue to do that. We've got a great guest coming on fixed income a little bit later this hour, in fact. So we'll continue to ask about the role that bonds do play. But yeah, we'll certainly be across that. Interesting to think how treasuries in that context might respond to the data, because if we are so positioned for sort of dovish outcomes, for the Fed to keep cutting, are we too positioned for that? Is the risk sort of asymmetric when it comes to the CPI print and what treasuries do on the back of that? It'll be interesting to see. How do you... Is it the PPI should give a clue as to into the CPI number, which will be fascinating to watch. So maybe you get a pre-warning on the CPI number. Plus, the PPI number has quite a strong feed into the PCE data. So, again, I think the market will be paying attention to that. So it's going to be really interesting to see when the market reacts.
And let's think about another topic on the agenda, which is all of the earnings stories. And you've mentioned some of the big ones stateside. And they are in focus because of the macro things they might tell us about the US consumer. So the likes of Walmart, the likes of Home Depot. Walmart, we've got some great data on Walmart and the way that it's been growing the business of late. And we've written before and we talked a lot about the broadening of the appeal, the way that people will trade down in tough times to something like Walmart. And so they managed to appeal to a wider range of income brackets. And so we've got some great data that shows that actually a lot of the growth has come from increasing footfall, getting more people in through the door rather than getting them to spend more on a basket when they're in the store, which sort of plays to that. But it could tell us macro things then.
So I think if people are... So it's good news for Walmart, bad news for the economy, I think is the first thing.
Yeah, maybe.
Because people are trading down and maybe you need to think about it that way. It's a sort of contra-indicator. Home Depot's interesting because it's seen a revenue decline over the last few quarters, which tells us maybe about sort of big-ticket items. Deere, I think, is going to be interesting as well. It's going to tell us a lot about what's happening with agricultural commodities and what is happening with that space as well. And I think the Deere story also, you can kind of almost draw a line to the US election, which I think is fascinating in terms of what's going to be happening in places like Iowa. But I come back to what are these companies going to tell us about whether or not we're seeing a recession? Because you and I have been talking to a lot of CEOs recently that have been basically saying we don't see a recession.
Yeah.
Is Walmart going to see a recession? Is Home Depot going to see... I'm
really interested actually in any kind of additions they can make to the suite of high-frequency data that we look at, because I know that you've been looking at some of the views on Wall Street, and I was interested in one that crossed our inbox. We was looking at Broadway ticket sales and box office sales, and I was thinking, this is new. I'm not sure I've seen this in economic research reports.
Torsten Stock always kind of posts these kinds of little snippets of the data that he's watching, and he kind of aggregates it every once in a while. The bottom line is, this is his latest note, the bottom line is that there are still no signs of a US recession. The US economy is doing just fine, with steady growth in daily, weekly data for restaurant bookings, as you say, air travel, hotel bookings, credit card data, bank lending, Broadway show attendance and box office grosses. The weekly data for bankruptcy filings are trending lower. In short, the Fed pricing is wrong. The market is making the same mistake it made at the beginning of the year.
OK, as we said, no time to relax.
Yeah, but it does. But if the market is, if the thing we learnt last week is how scared the market is of a recession, then Torsten's point over Apollo is that maybe there isn't one coming. We've got some great guests lined up. We're going to be talking you through all of these subjects. We're going to set you up for the week. Bank Pictet's fixed income strategist, Laureline Chazelan, is going to be joining us at the Open. Julian Howard from GAM, Merrill Lynch's head of European equity strategy. Sebastian Radler is going to be joining us. Bank of America, Merrill Lynch, joining us a little bit later. He still sees, I think he still sees 9% further downside for European equities. OK,
so there's a lot to talk about when it comes to the equity market conversation. Believe it or not, there are other events happening this week which we still need to tell you about, so let's do that. Today we get the OPEC August oil market report. That could be interesting. Lots of reporting over the weekend about refineries slowing down in the States because they're conscious of a consumer slowdown, so we'll watch that. US budget balance Tuesday, UK unemployment data is coming through, UK inflation data as well this week. On Wednesday we get UBS earnings. We mentioned all of these US corporates and we're rightly focus on those, but we'll also get the ongoing consolidation story from UBS. US and UK inflation, as I mentioned, and a host of corporates reporting over in the United States. And we have an important speech coming through from the Indian Prime Minister, Narendra Modi, his first speech of his third term. And thinking about consumers and sentiment, we have UMISH, the August consumer sentiment data. That drops on Friday.
Yeah, we'll certainly be watching out for that one. The market is very sensitive to a couple of things within that. A, consumer sentiment, and B, the relationship with inflation. Because it is unclear at this point what is happening on the inflation front. Is inflation trending lower? Is it sufficient for the central banks to be able to take action? The RBA is pushing back quite aggressively at the moment. And it's interesting as well, you're starting to hear voices out of the Bank of England talking about the idea that maybe inflation isn't coming down fast enough. Yes, it's the hawks, but we're going to get more data potentially pointing us in that direction as well, as you say.
Yes, the hawks are going to hawk kind of mantra rings in our ears. But then we have Michelle Bowman over at the Fed adding to that, saying the inflation is still uncomfortably high. And you see that in the year-over-year number above 3%. It's expected to stay over 3%, and it's difficult to argue that you're right at target if it's above 3%.
UK inflation is expected to tick higher.
Yes, because of some base effects and well-known things happening with fuel prices. But that could confuse the story, confuse the narrative for a central bank that is already cutting.
But wants to cut cautiously. So does that mean ultimately we wait until November for the next cut? How sensitive are we in November? How clearly defined will the narrative be by then? There's a lot of people now beginning to talk about this idea that actually you don't get a cycle. You don't get a rate-cutting cycle. What is a rate-cutting cycle? Is that 3 cuts?
Yeah, that was in one of the guest notes today, wasn't it? You know, they're going to cut, but it might not be a cycle. I'm going to get more on that. Does that mean 2? Does that mean 3? The market's pricing for a lot of cuts still next year. If it's not a cycle, is that just a mistake, or is it something more complicated than that? I don't know. We need to discuss this. What else do you need to know this morning? Let me run you through the details. The Ukrainian president says Russian troops have started a fire at an occupied nuclear power plant in southern Ukraine. Russia has seized the Zaporizhia nuclear power plant. It did so in March 2022, shortly after it's launched a full-scale invasion of its neighbour. Zelensky says radiation levels are within normal ranges at the plant, which is the largest nuclear power plant in Europe. In corporate news, Disney has unveiled new theme park attractions. This after it just reported weaker than expected results from that division. Plans include a new area devoted to movie villains within Florida's Magic Kingdom. That sounds like fun. As well as a Spider-Man attraction in Shanghai and in Hong Kong. Disney is also planning 4 new cruise ships. The Olympic Games in Paris has now drawn to a close, with the United States at the top of the medal tally. The US won 126 medals in total. 40 of them were gold. China came in second, also winning 40 gold medals. The closing ceremony last night had a Hollywood moment. Mission Impossible star Tom Cruise abseiling into the stadium. Paris will host the Paralympic Games in a couple of weeks' time, but we're handing over to LA. Handing over to LA, and therefore Tom Cruise has to abseil in. I mean, why not? Yeah. That seems to be how you do it. I suppose it's been brilliant to watch. I've spent 2 weeks of pretty much absorbed, glued to it. More than 2 weeks. Glued to things I didn't think I'd be glued to. Yeah. I mean, women's wrestling. I watched more of women's weightlifting. I watched more of that than I'd anticipated over the weekend. The water polo, all kinds of sports that kind of get on your radar that don't normally. But the other thing that we haven't been talking about when we've been talking about the Olympics is French politics, because they've got work to do. Emmanuel Macron, I think, has a press conference a little bit later on today, kind of wrapping it all up. But I think, as you say, it's been a distraction. It's been a welcome distraction to the French political story. Do we still have a prime minister? Do we still not have a prime minister in France at this point? How is that going to work its way out? It kind of feels like this has been a nice summer break. Yeah, absolutely. We'll get back to the business of politics in France, no doubt. Coming up, we will bring you the latest from Ukraine as tensions with Russia continue to flare up. Plus, we'll discuss the UK with GDP, inflation and jobs data all expected. Up next, back to markets, are bonds back in fashion? We will get that conversation underway. If you have any questions, please do get in touch with us. If you want us to put your questions to our guests, IB plus BBTV Go, that is the function that you use on the Bloomberg terminal. This is Bloomberg. 44 or so minutes until the start of equity trading here in Europe. Japan's closed today, which means we get a late opening of the US bond trade. So let's just tell you what's happening. We're up by basis points in the US 10-year at the moment. I think people are going to start positioning quite cautiously, maybe for what we get on the CPI front a little bit later on this week. We have had some early commentary on the outlook when it comes to inflation from Fed Governor Michelle Bowman, signaling a little bit of caution, I had to say, on cuts, talking about inflation, saying inflation is still uncomfortably above the committee's 2% goal. She says that she will remain cautious in her approach to considering adjustments in our current stance of policy, i.e. she's not quite ready to deliver that rate cut that the market is looking for. Mann making similar noises. Yeah, absolutely. So some of the more hawkish lines, I mean, we're hearing from some of the more hawkish voices, perhaps, over at some of these central banks, but does raise questions about where bond markets go then, because last week we saw a lot of volatility and a lot of preoccupation with the weakness in the US data. That caused a lot of people to go and try and seek some safety in bond markets. And then a lot of stories saying bonds are back. They've demonstrated their haven status. But does that last? I mean, does it last if we get inflation being stickier than we thought it would? Well, so if you get in a stagflationary environment, it may not last, because at that point you get a sell-off in bonds, and you get a sell-off in equities, because the growth story is coming down, hits equities, the inflation story stays sticky, the bond market doesn't like that either. That's a really terrible scenario in terms of most portfolios. The other thing is, what are we going to get in terms of the signalling
We've gone. This time last week, we were talking about 75 basis points of cuts.
Yes.
That feels like a long time ago. But
yes. Will we get an emergency rate cut? Yeah, that kind of thing.
Amazing. I think a lot of people are scratching their heads trying to understand why that commentary happened. But nevertheless, we've kind of gone from 75 midweek to 50. And now it feels we're kind of back to maybe the Fed delivers 25 basis point cuts. And that signals potentially more of a soft landing narrative. And
really interesting, and we know this is something we're going to pick up with one of our guests shortly, but really interesting to think about the signals we're getting from the corporate bond market and the way that they managed to kind of keep their cool. Yes, we saw spreads widen a bit initially, just as everything was panicking on Monday, in that Monday sort of mayhem. But by the middle of the week, the market was able to absorb a huge amount of corporate issuance, to some degree, just taking money away maybe from treasuries, and that was something that we talked about a little last week. But we also get, interesting to note, we also get a lot of issuance today, corporate bond issuance, trying to get in ahead of the CPI print. So you wonder again whether we might be back to talking about the corporate side of things.
It feels like the market's gone kind of upmarket, though, doesn't it? It's looking at IG rather than high yield. High yield, triple Cs, Bs, bottom end of the Bs, still struggling a little bit. So it feels like the market has maybe sought a little bit of safety at the top end of the market, which, as you say, in terms of the issuance, has been working fairly well. Laureline Rideau-Chatelain, fixed income strategies at Pictet Wealth Management, joining us to pick up on this exact subject. Laureline, good morning. Thanks for taking the time and thanks for the patience of getting this line all fixed up and allowing us to talk to you this morning. Look, the market has sought a little bit of safety in bonds over the last few days, both govies and IG. But what do you see at the bottom end of the market? We've just been discussing this. What happens to these high-yielding triple Cs? What happens to the bottom end of the Bs? Can I get back into the market and start picking up some really high yields at this point, or do I still need to be nervous about that space?
When we look, for example, at US high-yield triple C, we saw spread moving higher towards 1,000 basis point, which is considered a stress level. So we saw some stress in the market. It came down slightly at the end of the week. So I would say for now, it's still a bit risky because we would be more comfortable if the spreads remain well above 1,000 basis point, knowing that we have some risk down the road on the US economy.
Do we yet understand those risks? Do you see a recession? Do you not see a recession? If we get a recession, how does the Fed respond to that?
So on our side, we still stick to a scenario where we have a normal slowdown, I would say, in the sense that we could have some hiccups, but nothing major. So labor market slowing down, inflation slowing down, the economy slowing down as well. So this is obviously something that will potentially scare about a bit market participants at some time, because we've seen how strongly they have reacted to one print on the employment data. So on this side, we prefer to be a bit still on the cautious side in terms of an investment. And that's why we favor investment grade corporate bonds over high yield, because we believe, especially when you look at the overall high yield index, that spread at too narrow for now to give us comfort that there is enough risk premium in this market to compensate for this volatility that we expect.
Laureline, good morning. So that's the corporate side of things. If we pivot to treasuries for a moment and think about the broader picture for fixed income, we were talking a lot earlier on in the programme about how maybe bonds are back. People are asking this question. People are suggesting that could be the case given concerns around the US economy. You've given us your take on the US economy, but do you think we're witnessing a real pivot where bonds once again prove their haven status, demonstrate their haven status and get a boost as a result?
Yes, I think what happened also over the last 2 weeks is very key in how the market narrative has shifted, because now with the inflation that is rather moderating and the Fed clearly signaling its readiness to cut rates, treasuries have come back as a safe haven investment, and they have performed very well in the market turmoil we have seen. And in our side, so we do not believe 10-year yield will fall much lower unless we have more fears of recession in the market. And so we see them as a very good hedge for a balanced portfolio, I would say, that holds also risky assets such as corporate bonds or equities.
So they're a good hedge. How vulnerable do you think treasuries are this week on the data front, Laureline? I was reading the Markets Live blog saying there could be some asymmetry there, that if we get CPI or retail sales that come in hot, if the data comes in hotter than expected, given the market adjusted to thinking about a lot of rate cuts last week, if we get hot data, does that prove to drive bigger movement in treasuries this week?
Yeah, I think when we look at market participant expectation, what is key is that they expect at one point, by the end of this year, 50 basis points of cut from the Fed, right? And for the Fed to deliver this 50 at one meeting, we need either the job market to continue slowing down or downside surprises on inflation. And honestly, the last two prints, the month-over-month reading came below 0.2. This is what is expected for now by surveys. And so if we have a downside surprise again on inflation, that could actually bolster the Fed narrative for a 50 basis points cut. But we believe maybe we'll have some signal from Powell at Jackson Hole regarding September.
Yeah, I guess we wait for the incoming data. The CPI print will probably be pretty important at that point. What have we got this wrong again? Anna and I were just discussing a note from Torsten Slock over at Apollo. He's saying, in short, the Fed pricing is wrong. The market is making the same mistake it made at the beginning of the year. He thinks the economy is still actually strong enough to not need rate cuts at this point.
So I would say not any rate cut seems to be something a bit of a puzzle to me, because we see signs of slowdown on the inflation front, on the economy still, from the consumer. The lower end of the consumer especially is feeling the heat of higher rates. And I would say it's the same in the corporate world. So all this market that is on the floating rate is feeling the pinch of higher rates from the Fed. And so we believe they need to cut a bit, at least.
But a bit. So let's talk about a bit. 25 basis points feels like a bit. If they cut by 25 basis points, are we still back? Are we still in the soft landing camp? I.e., this is a managed slowdown. We can see a soft landing. Is that what a bit looks like at this point? And how many rate cuts do you need at that point? If this is a kind of mid-cycle slowdown, what does a rate-cutting cycle look like in that kind of a world?
So on our side, we did some work regarding the US election, actually, because we believe that the Fed could be influenced in its rate-cutting cycle by the outlook for inflation if we have, for example, tariffs that are put in place or a much larger fiscal deficit. So we believe that the terminal rate will be much influenced by the election outcome in November. And we have a range between 3% to 4% in this scenario. And if we go into recession, maybe towards 2% for the terminal rate. So that gives you an idea.
Yeah.
That is interesting. Just briefly, Laureline, when we're thinking about the need for cuts in the United States, do we need to think about it as cuts because the economy needs it, or just cuts because rates are too restrictive?
I would say it would be both, actually. The fact that the economy needs it is because we see the slowdown, and the longer it lasts, the longer it will feel the pain in terms of economy. So we feel, for example, for consumer, for corporates, we know that the longer it lasts, the more painful it is. We saw that on the housing market slowdowns, also on corporate, the high yield market, they have yields that are around 8%.
Laureline, thank you so much for your time. Laureline Renaud-Chatelain, fixed income strategist at Pictet Wealth Management. Thanks for joining us this Monday. Coming up, a new poll says Vice President Kamala Harris leads Republican opponent Donald Trump in 3 key battleground states. We'll discuss that next. This is Bloomberg.
Monday the 12th, good morning. 30 minutes to the start of trading here in Europe, 30 minutes to the opening trade. This time last week, the market was panicking. This time last week, the market definitely pushed the panic button. If you want to see a graphical representation of that, take a look at what the VIX chart looks like last week. Now, we've come down, but are we going to see a bumpy week this week, or is it slightly calmer? Is this the kind of the calmer week? And then we get into the following week when we get things like Jackson Hole, and we've got Nvidia to think about. All those sort of things are still coming up. CPI obviously is the standout story this week, Anna. At the moment, feels a little calmer than it did this time last week.
Oh, thank goodness, yes. Things do look a bit calmer. We've got European futures actually pointing slightly higher. Not sure they're getting that lead from US markets on Friday. I mean, we did see a bit of a pick up towards the end of the session in the United States, so maybe we're factoring that in a little bit. But US futures are pretty flat. Okay. They look more Augusty.
They feel, it definitely feels more Augusty, doesn't it? Finally, the market can maybe go on holiday for a little while. I don't know. Let's see. Wednesday, Thursday, I think could be interesting. There are a few things this week that could make life interesting. I'm really interested to see what the outlook statement from Walmart looks like. I think that's going to be absolutely fascinating. The component parts of the CPI, I think, are going to be interesting. You flagged UMISH on Friday as well. That should give us an interesting steer as well as to what's happening with the US consumer.
And how will the health of the US consumer or otherwise play into the politics? Let's talk about US politics, shall we? New polling by the New York Times suggests that US Vice President Kamala Harris has opened a narrow lead on Republican opponent Donald Trump in 3 battleground states. For more, we're joined by Bloomberg's Derek Warbank, who can give us the benefit of his many years covering US politics. Derek, good to speak to you. So give us your take on the significance of this kind of polling.
Well, it's good to speak with you as well. Look, I mean, this is a very different thing for Democrats who have become accustomed to the idea of trailing in polls and sometimes giving all sorts of manners of excuses for why that might be, to find themselves now with Kamala Harris instead of Joe Biden as the candidate, leading in 3 critical swing states in one of the most respected polls in the United States. Look, the map is really simple, right? The U.S. elects via the Electoral College, and I could go into a very complicated description here, but the simplest thing that people need to know is if these polls are right and if they hold up for 90 days, you win those 3 states, you win the rest of the states Democrats ought to win, and that's the White House, right? So that's how the math shapes up here. In addition, Kamala Harris, according to polls, has opened up a potential second pathway to winning through maybe putting some Sunbelt states in play that had been slipping away. I'm thinking here of Nevada, I'm thinking of Arizona, of Georgia, of maybe North Carolina. So there's a couple of different ways that she can maybe play in the 7 critical swing states where Joe Biden a month ago, was really having problems and where Donald Trump seemed to be on an ascendancy. What we've seen is a recognition of this, not just in polling, but I look at markets as well. You think of that Trump trade that people had been talking about, starting with Donald Trump's own listed company and working down, you see a little bit of an unwinding of some of that over the last couple of weeks. We've seen Kamala Harris in her rollout with her new running mate, Tim Walz. You can see him on screen, the governor of Minnesota, having a little bit of a smoother rollout than Trump did with his running mate, J.D. Vance, the senator from Ohio. You've also seen a very large uptick in both volunteers and in hard money donations to Harris's campaign. Yep.
Derek, Elon Musk is going to interview Donald Trump a little bit later on today. I was trying to... this is quite the cocktail. Walk me through... what are we expecting? I have no expectations. I've listened to Elon Musk speaking many times. He goes off on tangents, down rabbit holes. I'm interested to see how this is going to work. What are our expectations looking like for this Q&A?
Well, look, I look at this as the difference between somebody going on a sort of interview with like you would do with Bloomberg or anybody else and the sort of topics we might think to ask about versus going on a major podcast hosted by an entertainer. You know, you think of like Joe Rogan or Logan Paul or any of those guys who do something. The questions are likely to be very topically different. So I think that's going to be one of those things. I'm also really interested because Musk and Trump are very, very, very connected in a lot of different ways, not least of which that Elon Musk is a pretty substantial government contractor, his companies anyway. He's got a lot of business that's before the United States and where he and his companies are going to stand to have some impact by whoever gets in office and what they decide, be that tax subsidies that Tesla utilizes, be that government contracts for SpaceX or other things of that nature. So it's going to be really, really interesting. You know, Musk is looking at this as a way to promote X. You know, Trump has famously been mostly, not entirely, mostly off of X in favor of his own Truth Social in recent years. So there's a lot at play here that I'm kind of watching out for. Both the headline comments, but also that sort of stuff on the side that you watch for. I guess you'd say the vibes, the kids might say, but you know, there's a lot of that going on as well.
I think we can say vibes as well. I think anybody can say that, not just the kids. Derek, thank you very much indeed. Yeah, it's going to be fascinating. Elon Musk, I wonder if he kind of messes around with the sound desk and does all those kind of crazy things that we've seen in the past. Let's turn to a more serious matter for a moment. Ukraine's president says Russian troops have started a fire at one of the occupied nuclear power plants in southern Ukraine. However, Zelensky is saying that radiation levels are still in the normal range. You're looking at pictures of Zaporizhia in Ukraine. This has been an ongoing concern that we are going to see problems at this plant. We've obviously got a long history of Ukrainian nuclear power plants, and we worry about them a great deal. Let's try and get a handle on what is happening here. Bloomberg's team leader on Russia and the Russian government, Anthony Halpin, joins us now from Dubai. Tony, what do we know? Because this Zaporizhia has been this kind of really big concern that we've on and off been worried about. A fire at the plant looks reasonably serious. What do we know about what is going on here?
Yes, good morning, Guy. The International Atomic Energy Agency says that it wants immediate access to the plant to try and establish what exactly happened to start this fire and what the possible consequences might be. As you've noted, Ukraine's President Zelensky accused Russia of starting a fire there, and Russia has occupied that plant, which is the largest nuclear plant in Europe since the early days of the war. So it's clearly a concern if a fire has broken out there. It doesn't necessarily mean there's any immediate nuclear risk. The IAEA says that they don't see any elevated levels of radiation, but they're concerned enough to demand immediate access for sure.
And this comes in the context, then, Tony, of other developments that we've seen between Russia and Ukraine of late. Of course, a Ukrainian incursion into Russian territory. How is the Kremlin reacting to that incursion? What's the military saying?
Yes, Anna, well, state TV in Russia is desperately trying to play down this development. They're focusing largely on the assistance that's being provided to the tens of thousands of Russians who are fleeing the fighting. But just the fact that there are Russians fleeing their homes because Ukraine has intervened in Russian territory is sending a shockwave through the Kremlin, and the military is struggling to respond. We're already in the 6th day of this operation, and it's clear that Russia hasn't succeeded in regaining control of its border. There are reports today that residents in a neighboring region of Russia, Belgorod, are also beginning to leave the border because of clashes there. So it's clear that they don't have a handle on this. Ukraine is continuing its efforts to expand its presence there, and it's a big psychological blow for President Putin. His whole image with Russians and with people abroad is as a strongman ruler who has everything under control, and clearly this incursion, which is the first time in more than 70, 80 years that Russian territory has been taken by a foreign power, that really punctures that image with Russians and abroad.
Tony, thanks very much. Thanks for joining us. Bloomberg's team leader on Russia economy and government, Anthony Halpin. Let's pivot to other matters geopolitical. Hamas is calling for a plan to implement a ceasefire with Israel instead of a new round of talks. Meanwhile, Israel says an airstrike that killed about 100 people at a school in Gaza targeted a Hamas command centre. Let's get more on this story. Bloomberg's head of Middle East and North Africa, Stuart Wallace, is with us from Dubai. Stuart, what has been the global response and Israel's response to the latest attack on Gaza?
So it's more of the same. It is this escalation or certainly speeding up of diplomatic efforts. And this sort of really dates back to when you had that assassination of a Hezbollah leader in Beirut, and then you had the assassination of a Hamas leader in Tehran. And the feeling certainly over the last week or so has been that Iran will retaliate, and really the only question is when that happens and on what scale it happens. So you've had this diplomatic flurry with all sorts of world leaders being involved in trying to sort of de-escalate the situation. And I have to say, so far, at least, and you can hear the hesitancy in my voice, it does appear to be working. And now Iran came out again yesterday and said, it will retaliate. But the fact that it hasn't happened yet is quite telling. And we have these big Gaza ceasefire talks on Thursday, which may yield something, of course.
In terms of the sort of timeline here, I'm wondering how we should be thinking about it. We're waiting for the Iranian response. We're waiting for a Hezbollah response to the attacks in Iran. We've got the Gaza story as well. You've got the US moving significant amounts of equipment into the region as well. This process is unfolding on multiple tracks, Stuart, and I'm kind of wondering how we need to think about the timeline. Are the pieces now moving into place for something to happen?
I mean, these ceasefire talks, I think, are really at the heart of it. Now, that doesn't necessarily resolve everything, but it's a good step forward. So if you think about the rhetoric that you've seen from Iran and its proxies in Lebanon and Syria and Iraq, in Yemen, and indeed in Gaza, the fighting in Gaza has really been the reason why things have picked up, as it were, since October. If you can get some sort of ceasefire in Gaza, that removes at least one element there. But of course, as you point out, this doesn't resolve anything. And I think there is certainly a feeling within Israel itself that sooner or later, and probably sooner rather than later, they're going to have to deal with Hezbollah. In other words, they're thinking about the events of October, where they thought Hamas was contained. It clearly wasn't. They're now thinking the same thing about Hezbollah. And they, in some respects, want to think about a preemptive move of one form or another to try and contain them.
Stuart, always a pleasure. Thank you very much indeed for updating us. Bloomberg's head of Middle East and North Africa, Stuart Wallace, joining us from Dubai. Coming up, we're going to turn back to what is happening with these markets. We're going to look at which stocks you want to be watching out for. We've got Stellantis on deck. We're going to be watching that one. The automaker cutting thousands of jobs in the United States is basically looking to deal with a significant inventory build. We'll talk about that next, plus all the other names you want to be watching out for this Monday morning. This is Bloomberg.
Welcome back to the programme. 7:46 here in London. The futures picture looks a little buoyant this morning. We are expecting a bit of upside for European stocks. US futures, though, look flat at this very early Monday hour. Let's talk about the markets and where we are in the story. Markets Live executive editor Mark Cudmore joins us this morning. Mark, very good morning to you. Let's talk about the markets in 3 minutes. Calm. We see calm in front of us, which makes a change for the better, probably for many people, for the worse, if you'd like that volatility, a change from last Monday. What does the calm tell us about how we're positioned for a really busy week?
Yeah, good morning, Anna. I've been pretty surprised by the price action, I think, into the end of last week about quite how positively we traded. And I say that as someone who remains very bullish. I've been bullish all year. I remain bullish in year end. I don't think that we've had a sudden big turning point in markets. I think recession fears are overblown. But I do think that we're still going to get more volatility in August. And I don't think we should be misled by the calm today. Specifically, the calm in Asia session was a little bit exaggerated by the fact that Japan was on holiday. And remember, Japan was the epicenter of the recent problems. And so therefore, it's a slightly misleading session. So I think this week we can expect some more volatility, probably volatility with the downside skew. And I say that being very bullish. I'm still worried that we kind of head back towards the recent lows at some point, and because we've got some big data points at the later end of the week.
What are you watching out for? You got UK data this week, you got US data this week. Mark, what is top of mind right now, and how does it relate to the individual asset classes? Let's talk about UK data and UK assets.
So the UK's got a lot of data this week, and I think it's an interesting story. I think that the UK story is relatively positive at the moment in terms that we've got a little bit of political stability, the recent, obviously, riots and unrest, not ignoring those. But overall, from the top, we've got some political stability. We've got some kind of pro-growth trajectory. And I think that UK generally, we've been getting more optimistic on all year. We see that in the growth forecasts. So I think that there's upside for the pound, though I think people got over their heels on that one, or, a little bit extended positioning-wise, which is why you've had a recent retracement. But I think the structural story is positive. I think for UK equities, there's also a positive tailwind. My one worry is that I do think the Bank of England, and we see that with the report that came out via the FT this morning, that I do think the Bank of England will stay quite hawkish and won't be in a rush to cut. However, that's a global theme. It's not just the Bank of England, but they might be at the forefront of disappointing investors in those cuts that are priced almost all around the world.
Yes, and thinking about the other data points we have this week, of course, CPI, US CPI in focus. What would you expect the reaction function in Treasury markets to be to the CPI data, Mark?
Yeah, in line with my views on the Bank of England and UK yields, I do think there's an asymmetric risk of yields going much higher on a beat in CPI this week than going lower on a disappointment. And that's because we're pricing in an aggressive amount of rate cuts in the US that just won't be delivered unless we suddenly go into a recession. And that recession is not looking very imminent. Sure, there is a slowdown in the labour market, but finally, belatedly, we're still adding jobs, remember. This is not a collapsing labour market. Atlantic GDP now forecasts are 2.9%. This is not an economy in recession.
Mark, feels like a very different place than last week, doesn't it? Bloomberg Markets Live Executive Editor Mark Cudmore. You can find Mark's views, the rest of the team's views. MLIV Go is the function you can find on your Bloomberg terminal. This time last week, we were talking about emergency rate cuts,
yes,
justified by a payroll number which surprised to the downside, but has so many caveats attached to it.
And the timing of a rate hike, quite a small one from the Bank of Japan against that US data, really jolting the carry trade. And, yeah, the rest is history.
Do we have a recession coming? I think the thing we did learn last week was the market's really scared of a recession. And I think that's kind of the big takeaway from what we got last week, and a huge reaction.
And in a period of low volume and loads of people on the beaches, it definitely feels like all sorts of volatility can happen.
Yeah. Bad news is bad news, I think, once again. Even if you get rate cuts around that, maybe that wouldn't be necessarily enough. There's actually a few stocks that you could see some quite big moves in this morning. One of those is BT. Now, let's get the details on this. This is an interesting story. Joe Easton's got the details.
Morning, guys. So we're starting with BT, as you say. Now, this is breaking news. India's Bharti Global is buying around a quarter of the company, taking the stake from Altice, the French company that has been looking to offload it in order to reduce some of their debts. Now, we haven't actually got a price on how much they are paying, but as you say, potentially this could be one that we see a move in this morning. We actually saw a decent gain in BT shares earlier this year, as we can see on the screen here, following a better-than-expected dividend from the telecoms company. But they have a market cap of around 17 billion, so it is a pretty big move in terms of buying that 25% stake. One to watch, definitely, in the UK this morning. Then, in terms of autos, we're also looking at Stellantis, the company announcing a swathe of job cuts. This is over in a factory in Detroit, one of the factories that makes its Ram trucks. Now, they're going to be potentially eliminating around 2,500 hourly jobs, according to a statement. And it is actually the second lot of job cuts we've seen in the past few months. They recently did another one over near Detroit as well. But this is as the CEO looks to stem a decline in profits. Also, Sky mentioned earlier, do have a bit too much inventory in terms of some of those trucks at the moment. So that is potentially the reason for those. Then we're looking in insurance once again. This time we've got Hanover Re. There's a Stellantis chart on the screen there. We can just see that one down around 34% over the year to date. Pretty negative on that one. But in terms of Hanover Re, we've got better than expected net interest income, benefiting from all that cash that they've got on the books with the higher than expected interest rates, and that is actually one of the reasons we can see that stock outperforming recently. Now, in terms of some of their claims, the numbers actually lower than expected, so that is a potential positive from the earnings today, and it's another one that has been returning cash to shareholders in terms of dividends. As we can see on the screen here, 7 buys, 4 sells, including JP Morgan. Not the best, but that could potentially be a bit of a positive one this morning.
OK, Joe, thanks very much. Joe Easton from our Equities team with an update on some of those stocks that could be on the move. So we could see, as you say, guys, some fairly substantial moves. Certainly BT could be one of those that does move quite a lot. I noticed another story in focus, ThyssenKrupp and their steel business in focus. Some suggesting we could see a bit of downside in ThyssenKrupp, the steel division, and the amount of funding it needs in that division in focus. And that's getting some attention from some analysts. Morgan Stanley saying that the steel business plan lacks clarity. So we'll look for movement there.
Caledonia Mining could be another stock you want to watch out for. It's out with numbers this morning. They look like they're pretty much ahead of expectations. Certainly a name you're going to want to focus on. In terms of the overall market story, though, it does feel as if we are going to continue to see the macro story kind of having a greater impact. It does seem as if it's the Fed, the Bank of Japan, which feels like it's moving the needle at the moment. But the data are going to fold into that this week. And some of the corporates, I think, are going to be really interesting this week in terms of what they're going to tell us.
Yes, we'll get really interesting clues on the US consumer from the corporates and from that UMISH data around consumers. Interesting to think about where the markets have been moving through the Asia session. Japan has been closed, as you've been saying. Actually, the Chinese bond market's been quite active. We've seen yields bumping up there. Reminds me, we get quite a lot of data out of China all in one day later on this week. So we'll look out for that to give us clues on whether there's any turnaround in that story.
And how that feeds into the German economy as well, which is so important.
ZEW coming out this week.
Precisely, you've got that later on this week. I'm actually quite interested in UBS this week as well. I know Francine's going to be talking to Sergio Mossi later on this week. How have the clients of this huge wealth manager reacted to this volatility? How are they thinking differently? Are they thinking differently about what they're going to be doing with their money? Are they taking a more cautious stance? I wonder whether we get some clues within that UBS story on what is happening within these markets.
Yes, one view last week was that the whole thing was one big head fake. So we'll see what the view from UBS is. Stock futures point higher this morning. US futures pretty flat. The open is next. This is Bloomberg.
Monday the 12th, good morning. Couple of minutes to go until the opening trade here in Europe. Feels like a measured Monday. I'm not going to go as far as monotonous, but it certainly doesn't feel manic. This time last week, we hit the panic button. The markets feel much calmer today. In terms of the outlook for what kind of a session we're going to have, starting off cautiously. This is the legacy coming out of Friday. Europe closed kind of mid-range in terms of the US session. We did push cautiously higher into the close in the United States Friday. But as I say, cautiously, it wasn't a big move to the upside, but it kind of put the boat back on an even keel. Anyway, that's the story that we've got bringing us into this Monday morning. What do the futures look like as a result? There are some single stocks that you're going to want to watch out for. Anna will run you through the details of those just in a moment. But as you can see at the moment, Euro stocks fairly flat, FTSE 100 fairly flat. We'll wait and see whether the US gets a little bit of traction later on. The week kind of picks up as we work our way through the week. We do have some interesting events coming up. CPI out of the States, we're one of them. The UK's got a lot of data. We've got some big corporates, Home Depot, Walmart coming up later on this week. In terms of the cautious Monday morning, though, Anna, I think I'm going to go with moderate Monday.
A moderate Monday, yes. That's what we're dealing with this morning, certainly in contrast to last Monday. Let's talk about what we might see in some individual stock names. Might not be moderate moves in BT. We might see that one pop a little at the start of the trading session. Bharti Global is buying the Draghi stake in this business. The Patrick Draghi Altice stake is going to transfer from France to India. But they're making it clear this morning, the chairman of Bharti making it clear they're not after a board seat. They've no intention of buying the rest of BT, but we might see that stock pop. Hanover Re in focus, better than estimated numbers, no change in guidance. Stellantis job cuts is the focus there, Guy.
You don't get them all right. I think that's probably the view over at Altice. OK, here we go. The opening trade is almost upon us this Monday morning. Let's talk about the numbers that we are going to be seeing. We're anticipating a cautious but positive start here in Europe. So let's see if we've got some numbers coming through. Not sure this is the right data. But anyway, let me tell you that at the moment, I think you're probably looking at a positive start. I can see out of the corner of my eye. FTSE 100 is up by around 0.2%. You've got the Stock 600 opening up around 0.1%. As I say, a moderate Monday, I think, is probably what we're looking for. The Spanish market maybe delivering a little bit more. We'll wait and see what the other markets do. I'm not sure there's any kind of huge movers on the DAX or the CAC this morning. They're going to make those markets open a little bit more slowly. But there you go. The CAC Iraq maybe opening up 0.4%. Maybe it's just dealing with the legacy of last night and the closing ceremony over at the Olympics, Anna.
Yes, the DAX actually still not open, so that's where we still have some sluggishness. But as you say, modest gains then coming through across these European equity markets, up by 0.2% on the Stoxx 600. Looking at the sector picture, all sectors in positive territory apart from healthcare. That's the real area of underperformance, and Novo Nordisk appears to be having a bad day. So that is going to provide some downside weight given the size and scale of that business. Travel and leisure, the best performing sector. We saw last week that it was the leisure side, not the travel side, that was doing well. Well, today both seem to be not too bad. We've got some upside moves on the likes of TUI in the travel space, Flutter and Entain in the entertainment leisure space, moving a little bit higher this morning. Energy names doing okay, up by 0.6% on energy stocks. Some broad-based move higher for that particular sector as oil prices tick a little higher then, Guy. $80 is where we trade on Brent right now, up by 0.5% this morning.
I wonder how the geopolitics story is going to feed into that this week. We'll keep an eye on what is happening there. Do we see an escalation in the Middle East? Could that cause problems within the oil trade? It's interesting that other commodities are really softening up quite aggressively at the moment. Oil seems to be kind of holding in there. It's going to be interesting to see exactly what happens on that front. In terms of the stock stories that we're watching out for, Diageo trading a little bit higher this morning, maybe a sense of safety this morning. UBS into the numbers. LVMH is gaining a little bit of traction. So some heavyweights in Europe are gaining a little bit of traction on the upside, but it does seem as if there is a little softness in the healthcare sector this morning. Is that a signal maybe that the market is feeling a little bit more positive? Is there some specific news? Have I missed the note?
There's a Novo Nordisk seems to be on the back foot, but I'm still struggling to find the reason for that. We haven't got an opening price on some of the companies that have reported or there's news about this morning, also worth mentioning. So BT and Hannover Re, both of those still closed, so we're still waiting for prices on those. But yes, in the meantime, Novo Nordisk is one of those stocks that moves a little lower today. Let us get into a conversation about where these markets are. Let's talk to Julian Howard, who joins us from GAM, Chief Multi-Asset Investment Strategist, in fact, at GAM. Really nice to speak to you. Thanks for coming in, Julian. So let's do big picture here, because we came off a week that was pretty dreadful to start with, and then we saw a rebound in sentiment and all sorts of assets. So what do you make of the US growth story and where it heads? Because that was one of a number of drivers for the market turmoil last week.
Yeah, so I think US growth is actually pretty solid. I do feel I'm in the camp that last week was a bit of a scare over nothing, actually. I mean, if you look at the Atlanta nowcast, it's sort of over 2.8% annualized growth. The Q2 number was 2.8% annualized growth. Unemployment is about 4%. And yes, it's ticked up a little bit, but actually that's because a lot of people have entered the labour market. And if you combine that with jobs growth, that's actually a good thing for the US. And also for consumers, wages are still in positive real terms. They're actually making sort of headway in terms of their lifestyle is still positive against inflation. So I think that the background remains actually pretty solid. I think there was just a little bit of scariness around a couple of data points, that jobless claims a couple of weeks ago, and also that the non-farm payrolls was a little bit soft. But that's not a trend. One data point is not a trend. Usually you have to wait for 3 data points, and yet everyone has got themselves into this absolute tizzy. And I can't
does that make us nervous for this week, then? Because we have plenty of data out this week that could make everybody nervous and send us into another tizzy.
So what's
CPI, for example.
What's the common factor? I think it's the summer, isn't it? And I think a lot of the traders are off their desk. And there's nothing wrong with training up juniors, but the juniors are manning the desks. I can't help but think that there's a bit of excess volatility around that, because normally we don't get this sort of paranoia over single data points. So, yes, this week could still be a little bit volatile if that CPI number comes in unfavourably, if it comes in a little bit stronger than expected, and those Fed rate cuts don't materialise as expected. That could be problematic. But the growth background is fine. So I think for most investors who are set up for kind of long term, and you should be in it for long term if you're in equities, then this is potentially an opportunity to rebalance or even buy in.
So am I back to doing what I did before this time last week? Is it as you were?
Well, I don't think it should be traded around, to be honest, because I think if you're into equities, you're going to get the Siegel constant over a multi-decade period. That's a 7% real return. That Siegel constant is net of war, famine, pandemic, earnings crashes, recessions. It's net of all those bad things.
You had to have a really tough stomach, though, to ride through the pandemic with that as your background assumption. It's okay.
Oh, yeah, but that's what suitability is for. I mean, you talked about UBS's wealth management clients, but, the job of the private banker and the wealth manager is to set up the portfolio so that there are diversifiers and offsets in case equities do wobble. That's why you should have the short-dated bonds or the alternatives or the hedge funds to ride you through.
Okay, that's fine. But a diversified portfolio has underperformed. So does a diversified
well, depending on what it holds. I mean, if you held short-dated bonds, 2-year bonds or even cash, where you get, in the US, you get 5.25% with no risk. I mean, that has been the diversifier of the century, actually. If you've actually held that, every time equities go down, the rest of your portfolio just carries on, growing at 5%.
But if you've wanted to keep with the equity market, you've had to own big tech.
Yeah.
Do you still do that? Usually when the facts change, you want to rethink your approach. Sure. Did the facts change last week in any material shape or form?
I don't think so. But what is slightly different is that we are moving into this investment phase with AI. You know, the top 5 superscalers, according to research done by JP Morgan, are investing $180 billion over the next 12 months into AI. That is going to require some patience. And I think it does sort out the different types of investors. For the Reddit bros, they may not be able to stomach it. But I think for the long-term investor, that
investment is going to produce some volatility. It's not so the AI trade is not a one-way trade anymore.
It will produce volatility because it's going to take some time. We've priced a lot of it in, and now we have to invest and see the return coming through. And I think for some, should I say cynical? Maybe not cynical. Maybe more pragmatic. But I think, well, actually, I've got 80% of the return coming from this whole theme. Maybe I'll take some profit now and rotate away. But I still think there's juice in the AI trade. It is a major, major revolution. And these companies are run by smart people. They are putting huge amounts of money in. And it's not going to be for nothing. But it will take some time.
Yes, you make the point in your notes. You say it just requires patience. So what is the opportunity around other US stocks at the time when you still have confidence in those AI Mag 7 big names? I was looking at some analysis by Bloomberg Intelligence that says that the non-Mag 7 US stock universe is set to deliver its first profit growth since Q4 of 2022. So actually, despite all of the volatility we spent all our time talking about last week, if you go back to the earnings story, they see some sort of catch-up trade happening there.
Yeah, and I think you framed it correctly. It shouldn't be binary. It shouldn't be tech or. I think it can be tech and. I think you can actually broaden out your portfolio. I think US mid-caps are pretty interesting, actually. They're tied to the economy. As long as you're still confident about the economy, they are tied to the economy, and that's why you're seeing some of these earnings coming through quite positively. And they're quite big names. It's not like you're investing in a very obscure part of the market. Companies like Mattel, for example, or Alcoa, these are still relatively household names. And it just means that you're tied to the economy rather than what for some people might think is a more abstract concept, this AI revolution, which, as I've said, will take some time.
I hear what you're saying about what's happening with the economy, and you're reasonably confident. But what I did learn last week was the market clearly is scared of a recession. And any kind of indications that we are going to see a recession is going to produce some quite big amplitude in terms of the market swings. Do you think the data is going to become more ambiguous in terms of kind of where we are? Are we getting to the end of the cycle? If we are getting to the end of the cycle, what does the landing look like? I think is it going to become harder to judge going forward from here?
I think a lot of it will be consumer psychology and trying to understand what is going on with the consumer, because that is what's going to drive the US economy. And of course, this week we've got earnings from, I think it's Walmart,
Home Depot,
Target, Home Depot, and investors will be poring over that in minute detail to see if there's a slowdown. But also, I think it's worth bearing in mind, consumers have been on a revenge spending kind of trip for the last 3 years. And in fact, the car that brought me up, the driver actually said he works in the travel industry as a side hustle. And in fact, a lot of people have delayed traveling until this year, because I was saying, why are the airports full? How is it the airports are full? How have people got so much money? So because it's been delayed. So I think there is still spending going on in selected places, but also I think consumers are tightening their belts in others. And you can see this in autos as well. But it doesn't mean we're going to have a recession necessarily. It just means some tightening of the belt in certain areas. Food as well. Actually, there's going to be a little bit of a reversion back to eating at home, funnily enough, and a little bit less on eating out. But again, I don't think that's going to unwind the US economy or completely throw it off track. I think there's just going to be a little bit of a consolidation phase.
So 2024, and we're still dealing with the aftermath of the pandemic and all of the trends that put in place. The long reach of that. Thinking about another much-loved trend of late, that was to buy Japanese stocks. And then last week, we saw that tested a little bit. You have a fairly neutral view on Japan. Better governance is something that many people have talked about. Where does that stand now? Goldman Sachs putting out some data saying hedge funds sold stocks in Japan at the fastest pace in more than 5 years last week, and we certainly saw the negativity at the start of the week.
I may have become a bit more positive because the Bank of Japan, of course, last week basically said we won't raise rates while there's market volatility. That's a put. They've just reintroduced a put into the market. So actually, I think Japan is actually pretty well supported. And on the yen, of course, cheap yen, good for Japanese stock market because of those exporters. And actually, I think the death of the carry trade is being called a little bit prematurely, and I reckon that will reinforce itself and also support stocks. And the reason for that is actually there's very little inward investment. This is the story that people aren't covering. There's very little inward investment into Japan. The net inward investment rate is 5%. It's the same as Burundi. It's extremely low, and that's why there's very low demand for yen. That's what's underpinning the carry trade, rather than what's happening with the macro, what's happening with the interest rates, and what's happening with the inflation.
So even with all of that excitement about the Japanese story of late, still those low investment
I think
levels.
it will reassert itself. And also, improving corporate governance in Japan means that Japanese companies are actually investing abroad a lot more. So again, less demand for yen. So these are structural reasons that are actually underpinning the Japanese stock market.
You mentioned the 2-year earlier. Do I just keep owning the 2-year as my diversifier? Is that the right diversifier?
You could go even shorter. Why not own the 6-month T-bill? Because there's debate.
So just buy a money market fund as your diversifier at the moment. Does that work?
There's a reason there's trillions in the money market.
Yeah.
Because there's no risk associated with them, unless you believe there's going to be a US default and around the deficit. Okay, that's a separate conversation. But actually, if you look at the 3 to 6 month T-bill, that's really, really attractive. 5.25%. Okay, let's say they cut rates by 25 bips. That doesn't mean it's the beginning of a pathway all the way down to 2%. Even down to 3%, there's no risk associated with it. You'd be hard pushed to find a better risk.
Credit's a diversifier?
Sorry?
Is IG credit still a diversifier?
Yeah, credit is... I think investment-grade credit is OK. High yield, I'm a little bit more worried about. The spreads are very, very tight. 3.5% spread on US high yield. Anything goes wrong. Now, I've painted a kind of fairly solid picture of the consumer. Yeah. What if that goes wrong? Default rates go up, economy slows. It's priced for perfection. And so high yield worries me more.
You say in your notes, Julian, that the Fed could cut soon, but this may not be a cycle. I'm interested in what that looks like then.
I think it's the prevarication that's going on across all the central banks. I think the Bank of England also said this isn't the beginning of a cycle. The ECB, Madame Lagarde...
What's a cycle? What do you think a cycle is?
A cycle is we cut rates and we're going to carry on doing it in a very predictable
2, 3,
manner.
4...
Yeah, for the next 6 or 7 meetings, like we had in the old days.
Yes.
But now, because of the scare around, the whole transient embarrassment, embarrassment that we had in 21, 22, I think the central banks don't want to make themselves hostages to fortune. So that's why it's going to be very, very piecemeal. And also that's what gives me confidence around the very short-dated rates.
So forward guidance is gone and we're back to being data-dependent.
It's data, it's meeting by meeting. But, of course, that's not really compatible with the idea of long and variable lags. So there is a dissonance there. So that has yet to be resolved.
Time last week we were talking about 75 basis points of cuts potentially coming through. An emergency cut. Julian, great to see you. Thanks very much indeed. Julian Howard, Chief Multi-Asset Investment Strategist, joining us from GAM. Let's take a look at some of the biggest names we watch in Europe to give us an idea of what the core of the European equity picture looks like. Broadly positive. Most equities are up this morning. Certainly the bulk of the stock 600 is up this morning. There are a few notable exceptions. Novo Nordisk is softening. In fact, the whole of the healthcare sector looks like it's soft this morning. I've yet to put my finger on why. If anybody knows, I'm all ears. Please let me know. Maybe Joe's got some idea as to what is going on here. He's going to start with BT Group. It's just opened. What are we looking at?
So we have got to start with BT, Guy. We are seeing a gain of around 7% in that stock, the biggest move in 3 months for the company. We've got news that India's Bharti Global buying that 25% stake from Altice, the French company, their UK business. Drahi looking to get out of that, and as such, that is a decent move for that stock and the best stock on the FTSE 100 this morning. I also wanted to bring up Thiessen Group. So we've got news that they are offloading part of their steel unit. This is the company that's had massive restructuring over in Germany, but not actually getting a boost. A lot of negativity around that one. But in terms of the deal stories, it is BT taking the shine this morning, up around 7% at the moment. Then in terms of European earnings, we're sort of down in the mid-caps a bit at the moment, given that the bigger earnings are going to come later in the week, the end of the main earnings season. But Hannover Re getting a 5% gain, better than expected net interest income for the reinsurance company over in Germany. That one looking pretty strong today. Then we've got Aritza. This is the baked goods company, owner of Cuisine de France, maker of croissants and all delicious breakfast food. That one is actually declining, warning of weakness in some of their markets. Some commentary around a weaker consumer out of that firm today. And then back in the steel business, we've got Salzgitter, also actually specifically talking about a weak German economy in the statement. Quite an interesting read. If you want to take a look at that one, that's a maker of steel piping, that kind of thing, an industrial company, but weakening this morning. We're also going to stick on the breakfast theme. We've done croissants. We've also got coffee, JDE Peet's, announcing the CFO unexpectedly standing down. A bit of a surprise for the market, and analysts saying that is pretty negative, but actually only seeing around a 0.6% decline. The market is slightly higher more broadly, so a little bit of underperformance, but that was unexpected. They said he's got to deal with some other stuff at the moment, so he's had to stand down for those reasons. We'll take a look at Stellantis as well, announcing those job cuts, 2,500 over in Michigan, over in Detroit. It's the truck business, too much inventory on the books. Actually, not really getting much positivity in terms of the move on that one. We're down 0.1% at the moment, but it is a job cut story for Stellantis at the moment. There we've got some details on the screen very handily. 2,500 positions being cut. The CEO continuing to cut jobs as sales do decline. And as we said earlier, they did actually announce in December some job cuts for a similar reason, but not really boosting the stock. Too much negativity in terms of the inventory for that company. Then we'll bring you the morning calls. JD Sports cut to sell at Deutsche Bank, which says that US sportswear is declining actually in terms of some of the demand, and the costs are too high according to Deutsche Bank. So that's one of the worst performers in the UK, down 2.5% for JD Sports. But going the other way, we've got BE Semi. This is the rival to ASML, the chip machinery company. This one gets a buy at Stifel. That stock has slumped recently given the sell-off we've seen in tech, but they now see value in BE Semi. So that one is rising over in Amsterdam. BE Semi upgraded at Stifel this morning.
Thanks very much, Joe. Joe Eaton from our equities team with some of the movers today. Still looking at Novo Nordisk, Guy, and the drop there. 1.7%. I mean, to be fair, the rest of the sector seems to pull back from some of the losses we saw right out of the gates this morning. But this stock is still weaker, and it's such a heavyweight in Europe. Yeah. It has such an impact. And all I can add is that the volatility last week was quite unusual. If you look at how much it was down and then up and then down and then up, it was quite unusual for the stock. There was a lot of news flow around it, the company itself, its products, and then there was also the competitive environment for Novo as well that was in focus last week.
I'm trying to see if there's anything on Lilly that maybe caused it Friday. It's not ex-dividend. Anyway, I have asked a bunch of people. We may come back with an answer shortly. We'll figure out exactly what is happening. But equities do feel largely becalmed this morning. Is this basically a sort of moderate, measured Monday that we're going to wait? This is the kind of the calm before the storm. I can't put my finger on what exactly that cause could be, though, yet. So it's going to be really interesting to see what that CPI print looks like. As we were just hearing, maybe you do see the Walmart numbers being poured over in a great deal of detail. The BT story, though, is certainly one that stands out this morning. Yeah. This was there's always been a lot of kind of buyer's remorse around that stake. So the fact that he's offloaded it, I haven't actually seen a price yet. Maybe I missed that from Joe. But it'll be interesting to see exactly how Bharti's going to take this one and how this produces a different outcome, maybe for BT. Anyway, we'll talk about that a little bit more. India's Bharti Global has agreed to buy just under a quarter of the UK's BT group. We're going to figure out exactly what is happening here and what it means for the group going forward. Those details are to follow. We figured this one out. We'll figure Novo out as well. Just give us a little while. This is Bloomberg. What are we, 22 minutes into the equity session, and a much calmer feel this Monday morning versus the last Monday morning that we had. European equities are up 0.1%. London getting a little bit of a boost this morning. Bunch of factors behind that. One of which is that we've got BT shares up strongly. This after news has emerged within the last hour or so that Bharti, India's Bharti, has agreed to buy a stake for around 24% in the company. It's buying that stake from Altice, the French company. Let's get more details about what we know and don't know at this point. Bloomberg's conglomerates media and telecoms reporter PR Sanjay joins us out of Mumbai. Sanjay, what do we know about this transaction at this point?
So it's a very significant transaction for Bharti Global matters, because this investment is done by Bharti Global. Bharti Global is an investment arm for the Bharti Group, the conglomerate which covers telecom to digital to hospitality. That's number one. And the transaction is done by Bharti Televentures Limited, which has no connection with the Bharti Airtel Limited, which is India's #1 wireless carrier, or any other subsidiaries. This is done at the investment arm level, and they have agreed to pick up the stake of 24.5% in BT Group PLC at this point of time, and they will be going for the first tranche would be around 9.99%, and remaining will be done after the regulatory permissions are in place. And they have bought out at least stake as of now, and this is as part of they will get more firepower for their international expansion. And you would know that Bharti was helping in resurrecting OneWeb, and they have a huge investment in Africa too in terms of wireless carrier. So this is seen as an international expansion, and they will be getting more firepower with this kind of one large chunk. If you recall, in 1997, BT has acquired a small stake in Bharti Airtel, which is #1 carrier in India. So this is kind of India-UK relationship getting more cemented, and Bharti Group will now go for a search for new areas, new pastures for investment. As long as Bharti Sunil Bharti Mittal is concerned.
And Sanjay, we've heard from the chairman of Bharti today, making it clear that there's no intention to bid for the rest of the business. So with that in mind, what makes it attractive, do you think? Is this, you've mentioned the international expansion story, is this a play on the UK, or is it a play on telecoms? What do we think?
So he had also mentioned one thing. Now he's buying only a 24.5% stake, and he's not said clearly that whether he will be buying the remaining stake at this point of no. So we have spoken, we have managed to speak to sources, but they're saying at this point of they're only buying this one, and he's endorsing this deal as a deepening, or rather cementing or consolidating their investment efforts in the UK, because both the Indian Prime Minister and UK Prime Minister have laid out their investment plans for India and more further ties between these two countries, and they are endorsing, or they're rather flagging this one as a flagship investment from India to boost efforts from Indian Prime Minister Narendra Modi.
OK, thanks very much, Sanjay. Good to speak to you. Bloomberg's conglomerates, media and telecoms reporter PR Sanjay joining us there from Mumbai. So that's the BT story then, Guy, up by 6.4% this morning. So that's one of the movers that we're certainly keeping front and centre today. I noticed we've got some movement in some of the insurance businesses as well. Hanover Re, we were hearing about that from Joe a little bit earlier on. Jefferies pointing out there could be an uplift to guidance given the way that they're beating, according to their views, across the board. This business.
My quest continues in terms of why Novo is down as much as it is, because it's got a decent weight, like 2% nearly off on Novo Nordisk this morning is some weight to the downside. From one of my good friends and colleagues, some rotation is the best guess after a strong run, but didn't see anything too compelling. The search continues.
Yes,
we will find out if there's anything more to it than that.
Coming up on the programme, a week on from Manic Monday, we will talk to Sebastian Riegler from Bank of America Merrill Lynch about the risks he's watching in equity markets. Are we done with that selling from earlier on in the week? Perhaps not, is his view. We'll get more on that shortly. This is Bloomberg. Welcome back. This is the opening trade, 30 minutes into Monday's session, and European stocks are bouncing a little this morning, up just 0.3% on the stock 600. London getting the best of some of those gains. Energy stocks not doing too badly. The oil price up above $80 on Brent now, and so energy is one of those sectors doing well. Also insurance and financial services to the upside. We still have a little bit of negativity on healthcare. It's actually being joined by another couple of sectors that are just coming under a little bit of pressure this morning. US futures are pretty flat and mixed after a lot of volatility last week. And that's maybe where we want to start the conversation with Sebastian Riegler.
Let's start the conversation with Sebastian Riegler. Sebastian Riegler has been on the downside in terms of his outlook for European equities for quite some time. Did last week start to maybe provide some proof of concept? Are we starting to see some of the theories that he's been talking about starting to actually become reality? He joins us now around the table. He's the head of European equity strategy at Bank of America Global Research. Good morning.
Morning, Guy.
You've had a downside target for European equities.
It's not been an easy time, and we've been saying the labour market will wobble after the aggressive tightening that you've seen in terms of monetary policy, and I would argue we're now starting to see the first signs of it, and if that continues, there's more downside for the market.
You've got, what is it, 9% more downside from here? Is the risk of the downside on the downside?
I think there's a downside squared, if you want to put it that way. Because it assumes that we just get a little bit of labour market weakening. But if history tells us anything, once that starts, it tends to feed on itself, and you typically don't get a little bit of it. So I would say 10% is the base case, but once things get going, it could be more.
And that's European stocks from here, is it?
That's the European equity market, yeah.
And where do we see, which of the sectors are moving most in this situation?
Now, the interesting thing about the sectors is the sectors are far more advanced in pricing the scenario that we're calling for, which admittedly we haven't seen yet. Cyclicals versus defensives hit a 30-year high in April. They're down already 15%, so we only have 5% downside left. But the interesting thing is it's very bifurcated. Everything that is consumer has already gotten pulverized. Autos, luxury goods, airlines, all of them below the lows that you saw in 2022. Capital goods still very high, banks still very high. They look vulnerable to us if the negative tail scenario starts to materialize.
So banks look vulnerable. But how does that reading on consumers and what stocks in the consumer space have done, how does that fit with all the conversations that we have with CEOs who tell us the US economy just doesn't feel like it's in a recession right now or heading in that direction?
If we are right, we are very late cycle right now. Late cycle means the unemployment rate is low, the savings ratio is low, demand is still very strong, but you see the first signs of things starting to roll over. And a telltale sign of the late cycle is that the data becomes very amorphous and very hazy. So we see very conflicting signals. Consumer confidence in the US has crashed. It already tells you there's a sharp slowdown. Look at the Q2 results in Europe and the US. A lot of companies are telling us, the consumer is getting weaker. You saw the McDonald's result, first negative sales growth since 2020. And on the other hand, we still see top down. If you look at the GDP data, it's still holding up. It's very ambiguous. It's very hazy. But if history is any guide, we know which way it's going to go.
The Stock 600 is exactly at 500 right now. 10% downside takes us down. Let's get into the mid-450s. How much lower could it go? How much of the huge ramp-up that we've seen in global equities gets unwound during the down phase here? Do we go back down to levels we saw coming out of the pandemic? Do we kind of completely retrace? What are you thinking about in terms of the way the downslope works?
I think it's a super interesting question, especially given that there have been so many gains. And a lot of people are now starting, we see it in the fund manager survey, which we publish once a month. People start to think about, what do I have to lock in? How low could it go? The best gauge is the US high-yield credit spread. These are global risk premia. When everything is fantastic, you're at 300 basis points. Now you're at 350 basis points.
350, 400, yep.
In a typical recession, you go to 1,000 basis points. Now, you could argue the credit market is better this time around, better leverage, better ratings. Maybe you only go to 700. That's the argument from our credit strategists in the US. So if you go from 300 to 500, was our base case, it's 10%. If you go from 300 to 700, it's 20%. If you go to the 1,000 that you have gone to every single hard landing, then it's 35%. So this is the best way to
European equities or US equities?
European equities highly correlated to the US high-yield credit spread.
Okay, and what does that tell us about the broader economy? That's a warning signal that if high yield is coming under a huge amount of pressure, it doesn't just stay contained in high yield and it spreads.
No, I would actually say it's the other way around. Think about it like a fever curve. The high-yield credit spread tells you how well the economy is doing. If the economy doesn't roll over, it's basically the economy moves first, and then the high-yield credit spread just shows you what's going on. If the economy holds up, if the unemployment rate stays at 4%, this is a soft landing, this is the first time that we have low unemployment permanently without it basically rolling over, then the credit spread doesn't do anything and our thesis is wrong. If the labor market rolls over, you will see the immediate impact in terms of credit spreads widening, and then it feeds into cyclical underperformance, financials underperformance, and the equity market going down.
Is there anywhere to hide in that kind of process?
I think treasuries look very attractive. There's across the board, if you listen to our global strategist...
The equity guy's talking about bonds.
I know, I just flicked back to the front of my notes going, I'm sure these are equity conversations we're supposed to be having here.
But I thought to make it fun, I thought we always make it cross.
I always make fun of it.
In that scenario, you will see wider risk premia, but lower rates. And we've seen really a little proof of concept, I think is really the right term. The moment you got the payrolls report, immediately we went down on the Treasury yield, 70, 80 basis points. But you're still pricing a Fed that will not even get back to neutral. So if the labor market wobbles, the consumer gets weaker, especially with inflation fading, there's a lot more scope for the central bank to become dovish. So it basically means Treasuries will do well and gold will do well, because gold is highly sensitive to moves in real bond yields. In the equity market, because you want me to be an equity strategist, look at staples. Food and beverages down 30% relative to the market over the last 2 years. Cheapest sector in the market, highly sensitive to credit spreads. There's a lot of upside. I would say it's a once-in-a-generation buying opportunity to pick it up at these levels if the labour market starts to roll over.
If the labour market starts to roll over, OK. But super sensitive to credit spreads, but in a reverse.
Exactly. Right. In a positive. The higher they go, they got completely beaten up as credit spreads went to an all-time low. Now you pick them up basically with credit spreads. Credit spreads have only one way to go. The moment they go there, staples will do well.
What about other investment themes that we've talked to lots of equity investors about over recent months and years? Is there any sense that any of them have sort of structural potential through the cycle? I mean, maybe not AI, because that seems to be, or maybe AI, I don't know. But what about, grid electrification and all of that sort of stuff?
I think all of these things, and I would even say I would be very positive on AI over the next 3 to 4 years. I mean, maybe I've started to drink the Kool-Aid, but it's very hard for me to see how that is not transformational. We've seen so many powerful application cases. The problem was the market was pricing for this to boost productivity growth right now over the next 6 months. Nothing in the history of technological adoption tells you that's plausible. It takes 3-4 years for this to be adopted. I would still like the medium-term outlook. And then if you think about data centers that hang on that, electrification, the green economy, all of this is very attractive. But the problem is the themes and the place on this. Effectively in Europe, that's capital goods. They're already the most expensive sector in the market. They are allergic to credit spreads widening. So I would say it's not the right moment to engage in that trade.
How much is politics going to introduce into this story? What does volatility look like as a result of the US election? We've still got a lot of unresolved issues here in Europe as well.
Yeah. So if you look at the betting markets right now, for the first time we've got a lead for the Democratic candidate. To simplify the situation, I would say the Democratic candidate is basically the status quo. That's basically the legacy. Yeah. It basically doesn't introduce a lot of policy shifts. Now, if you get Trump winning, at the moment the betting markets have him down. It's roughly 46. There's a great function on Bloomberg, which I recommend, WSL election, strongly recommended. Where you can follow all these odds. If Trump wins, there was a big discussion. What actually is the Trump trade? Is it a stronger dollar? No, he pushed back against it. Say, I think the risk is if you get Trump, it could be another inflation shock because all the policies he has, they're effectively inflation.
So a higher terminal rate from the Fed.
It basically means potentially the Fed is in a bind if the economy weakens, but you get basically more of an inflation shock because you crack down on immigration, you impose more tariffs, and then you basically have a Fed that is far more constrained, and it's an upside risk, effectively, the bond yield, relative to that call that I just made for bond yields to decline.
If you're wondering what that function looks like, that's what it looks like.
There you go. Sebastian calls for the function, and the team puts it on air. Very nice. Sebastian, we've been around the world a little bit, but with your European equity hat on, what are you looking for from China? Because China doesn't seem to have been the story that's moved anything.
I think it's so well observed.
And yet we've got data, a lot of data coming out this week. Any chance it can change the narrative, or are we still sort of asleep on that story?
I think you're really putting your finger on something very important. For the last 10 years, it was China basically driving the global narrative. And it feels a little bit that China has gone the way of Japan, i.e. it's been sidelined, it's been a little bit isolated, and it's no longer so relevant for the global narrative. Where you really see it in the European equity market is mining. Mining has been a huge underperformer because it has caught the China vibe, which has been very negative. Ironically, we would be more positive on China on a relative basis because we are so respectful of the lagged impact of monetary tightening, which you're now digesting in the US, and you start to see the unemployment rate up 90 basis points. You see it in Europe. Look how Germany looks. You can basically the economy cannot basically improve. China is the only major region where you're not digesting a huge monetary tightening effort with a lag. So we think the whole global picture will be weak because everything hangs on the US, but China we think will be a relative outperformer. So we like some of the China plays, like luxury goods, for instance.
And when do we see that come through?
So we would expect right now the credit impulse very weak in China. You should now start to see basically an uplift. It's not a big kind of trend-defying turnaround for the global economy, but the PMI could go up, call it 3-4 points. And then luxury goods and the China, maybe even the autos, they're going to breathe more easily because they have been under pressure.
Are the highs in for equities?
I think so.
So there isn't going to be another opportunity to unload. If you want to get out, you need to start thinking about that now. There isn't going to be another...
Well, the one thing I would say, and I think it's something that everybody who's in the market is hugely aware of, it feels enormously ambiguous and hard to read. As one of my clients was joking, so whenever you think you've identified a macro trade, you can be sure that the next two data points are going to go the other. So therefore, I would think about it in probabilities. I would say 70% probability, maybe 80, that the high is in. There's a good case scenario, which is the labor market holds up for another 3-4 months. The Fed eases, and then you get one last uplift from a lower discount rate. But you have to be extremely lucky, and I think the probability is not higher than, call it, 20-25%.
That's interesting because, yes, if the Fed is cutting, but there's still a little bit of strength in the economy. And it's not cutting because the economy is weak. It's cutting because rates are a bit too tight for where we are. And that gives a different dynamic.
Exactly, and that would be the positive case scenario. But I'm so respectful of historical dynamics. If you say this would be a scenario where the yield curve uninverts without there being macro trouble, and I'm just saying we've never seen it over the last 50 years, you would really have to bet on something that historically you haven't seen, which is theoretically possible. And I say, okay, if you haven't seen it historically, I wouldn't put too high of a probability on it.
But does the process get elongated? Because of the way we've come into this differently, because of the pandemic, because of a bunch of factors, is the end of this cycle harder or easier to read? Does the process of rolling over take longer? You talk about the Fed being able to maybe to deliver a couple of kind of soft cuts, and we're kind of managing the economic slowdown. If the Fed can manage that turn neatly, does that change the outcome for asset prices?
So I would say, first of all, is it more elongated? If you think back to all the conversations, Guy, we had over the it has been very elongated.
Okay,
We've been waiting
fair point.
I think now things are starting to move. If it is elongated, it's because you've got so many weird factors, the residual impact of fiscal easing, the boost from immigration, the fact that productivity growth is running higher than normal. With regards to the Fed helping to ease the cycle, in my understanding, monetary policy works with a lag. And there has been a long lag for the hikes that started in early 2022, now to start I'm highly doubtful on the idea that monetary easing is going to work a lot quicker. So they're going to do it, but I think the historical playbook suggests it takes a while for this to come through.
But the market prices it in quite quickly, and that's certainly a factor, and the Fed's got a lot of room to move.
The market has priced a lot of Fed easing. What the Fed market would have to price is for this to help the economy. If you get Fed easing, but at the same time the labor market rolling over, you're in the same situation as in the middle of 2008 or at the beginning of 2001, which is the Fed is working to ease, but the labor market rolls over, and you know what the market does.
So rate cuts are bad, not good, is the way we should think about rate cuts.
No, I would say rate cuts are good, as Anna is saying, if they're voluntary, if you do it out of basically out of choice. If you do it out of necessity because you're responding, think about what happened is the labor market weakened and immediately everybody was pricing in a dramatic amount of Fed easing. If you price Fed easing because you see things breaking, net, that's never going to be a positive thing.
Nice to see you as ever. Thanks for stopping by to see us. Sebastian was promising us some jokes about round tables, but we didn't quite get that.
Next time.
Kept me too busy.
Next time. Yeah, we've got things to talk about. Sebastian Radler, Head of European Equity Strategy at Bank of America Global Research. Great to see you. Thanks for stopping by. Up next, we need to talk about some of this data, this hard-to-read data right now. UK CPI data due out this week, likely to give the Bank of England another reason for caution on cuts. It's actually potentially going to tick a little bit higher. We're going to speak to our chief UK economist here at Bloomberg to get a take on what we should be looking at here. This is Bloomberg.
Welcome back to the opening trade, 47 minutes into Monday's session, and it's okay if you didn't appreciate the volatility of last week. You can look at your screens. We do see a bit of upside in stocks. If you like the volatility, well, things look a lot quieter this morning. We're a little bit higher across European equities. US futures actually turning a little more positive as we are going through the early hour of this European session. We're up a couple of tenths of a percent on E-minis and Nasdaq futures now. Let's turn to some of the other data points we'll be watching this week away from US CPI. A raft of UK data is due out this week, and it's likely to keep the Bank of England cautious about how quickly it can cut interest rates this year. Let's talk to Dan Hansen, Chief UK Economist at Bloomberg Economics, with us to discuss. So, good morning to you, Dan.
Morning.
Lots of data points then from the UK. We've got the usual trio of data data points with the labour market data, the price data, CPI and PPI, and then the GDP data as well. I suppose we've got a Bank of England that is cutting rates, but going out of their way to tell us that, we shouldn't expect a lot of cuts in a hurry. So what's the key data point that you're going to be watching for this week, then?
It's quite boring, but I'm going to say services inflation. The bank have been quite interesting, the way their reaction function has evolved. I think they've shifted away, I think, a bit from the data and become a little bit more forward-looking in their reaction. Nonetheless, it is very, very difficult to be cutting when services inflation isn't falling down. And we know that CPI is going to pick up, but that's an energy-related point. I think they're going to be really keen to see services inflation come down because, remember, they look through, to do the August cut, they look through a massive upside surprise on services inflation, 0.6 percentage point. So I think that's, if you're going to pick one data point, that's the one.
If they hadn't cut, how much harder would it be to cut now? I
think, we were just discussing this off camera, but I think they would get into a world where headline inflation is on the rise, which we know is going to happen over the next 6 months. And I think the optics of that are really, really difficult, particularly when you're going to do your first one, saying they hadn't cut in August. I think people would look at them and say, you had this window in, to be honest, I think they probably would have done it in June, had the election not been there, but they waited till August. People would look back and say there was 2% inflation, services inflation, it was high, but coming down, pay high, coming down. But now we've got headline inflation going back up. And to be honest, the way gas prices have moved recently as well, it's not unthinkable to think you get a 3 handle on headline inflation towards the end of this year, which is just a really difficult situation to be in.
And we're getting a reminder of that from external member of the committee, Mann, talking to the FT, saying the UK should not be seduced into thinking the battle against inflation is over. I mean, she's somebody who we've heard a lot of hawkish things from in the past. So I'm not sure this is new information for the markets, but is that something we keep on our radar?
I think so, and I think, we know this decision in August was finely balanced for the ones that even voted for the cut. Most of them said it was finely balanced. So I think Catherine Mann's probably going to be the last hawk standing, if you like. She will continue to bang the drum on this stuff. I mean, one thing for me, actually, it's interesting she picked up on pay growth, because for me that's the one thing that's probably behaved a little bit better than the bank had expected. And if you look at forward-looking indicators, things like their decision-maker panel, it looks like pay growth is going to head down closer to 4%. And, in the next few data releases, pay is going to fall quite sharply, because of base effects. But she's right, and 4% isn't good enough for 2% inflation in the UK. 3% pay growth is what you need for 2% inflation in the UK. So there's that last mile, if you like, on pay growth.
How big a danger is there that August looks like a mistake?
That's a good question. I don't think it does. I think you'd have to have. I think at 5% you're still pretty restrictive. So I think what you would end up being in a world of is one and done, rather than the idea that, I think the mistake would be the idea that you would not commit, but still be signalling that more cuts are coming, which is what's consistent with their forecast. Yeah. They've got a forecast of rates coming down to 3.5% on the market curve.
On the market,
inflation undershooting target. So they're telling you 3.5 is not low enough. They need to go further. So actually, I think the mistake isn't necessarily just doing that one in August. It's the idea that setting the market up that there is more to come.
The expectation,
Yes.
How do we work in the fiscal unknowns here? Because, I mean, they're price takers, aren't they, on this? They
Absolutely,
have to just price in whatever the government gives them, but the government isn't going to give them anything until quite a bit later in the autumn.
Yeah, so that's going to be something really key for the November report. We know there's going to be almost certainly a fiscal loosening. The announcement that Rachel Reeves set out, it's very hard to imagine that borrowing isn't going to be higher this year. She's not going to find another £16 billion worth of savings this fiscal year. So it's then what comes next. And remember, they've got a 3-year forecast window, and it matters what happens in terms of tax rises over that window and how much that hole is plugged. But I think it's a big thing, and they sort of dismissed it in the press conference, particularly around the pay rise in the public sector. They didn't seem that fussed about it. But no, nonetheless, I think it is a risk, and I think it is something that they're going to be taking on board, and particularly if growth continues to hold up.
Why is growth holding up? Where are the drivers? It's the service sector economy. Looks like it's doing quite well at the moment. Yet there are warnings coming. You look at what is happening in travel. You talk to people who work in the hospitality sector. They're starting to see maybe some signs of things certainly softening. I'm not going to say slowing down significantly, but they are certainly softening. Yet at the same time, wages actually remain relatively elevated. What are the growth drivers and how sustainable do you think they actually are here right now?
I mean, I viewed the first quarter growth surge, and we're going to get one in the second quarter, by the way, as well. It feels like a bit of a relief rally on the back of a fall in interest rate expectations. Housing investment picked up very sharply. I think the interesting thing, and you've picked up on it there, is that the story this year was meant to be about strong real income growth, consumers driving the recovery. But what we haven't really seen that. Like, consumption it's growing, but it's growing very modestly. The saving rate continues to rise. So actually, that's a story of cautious consumers. If I look at it, the saving rate shouldn't be rising if you're happy about the future, if you feel comfortable. So I think that's a really interesting question in the second half of the year. If consumers turn up, then growth could be extremely strong in the second half of the year. But if that cautious sort of higher saving continues, then I think we will get this step down, and that it will look like a relief rally in the first sort of couple of months of the year, and they're the two sort of strong figures in Q1 and Q2 that we're likely to get.
Dan, great to see you. Thanks for stopping by to see us and update us. We've got some big data coming up. We're going to be monitoring this story throughout the week, bringing you back to the data. Dan and the team doing some great analysis on what we're looking at here, joining us from Bloomberg Economics. What do we got out for the rest of the week? This week's kind of interesting. There are some really interesting things. So you got the OPEC story, which I think is going to be well worth watching. You got the US data, UK unemployment data. We'll vaguely keep an eye on that. PPI is the number that you definitely want to watch out for, because that's got some quite useful lead indicators into PCE. But actually, I think the corporates are really interesting this week.
Yeah.
You look at some of the names we've got out. UBS is out, Walmart is out, Baba's out, JD.com is out. All of these things are going to be coming out throughout the week. India's interesting as well. UMISH Friday is going to be interesting. Joanna Shu's data is going to be fascinating to watch. But I'm quite focused on some of these corporates.
Yeah. They're sort of giants within their field, aren't they?
Yeah.
I mean, certainly UBS, Walmart, these are, some of the corporates listed or based in China. They're giants in their field, and therefore they can tell you interesting things about the macro. And you combine that with the UMISH number we'll get on Friday about the US consumer. So, there's a danger. We learned quite a lot this week about the consumer strength in the US or lack of it. And I know Dan was talking about the UK, but interesting to think where that narrative goes. I'm interested in the oil story. We do seem to have oil prices on the rise a little this morning, $80 a barrel on Brent now. Oil's kind of steady, but tracking a little bit higher, keeping an eye on the geopolitical risks, and, of course, waiting for that monthly report from OPEC.
I don't know how much geopolitical is in the price, geopolitics is in the price there, because in theory other commodities have been softening up a bit. If you've got a recession fear, you'd have expected oil to have come down further. It didn't do that. So does that tell you that actually that trade is still on, that actually we are going to be seeing heightened tension in the Middle East? And you bring Iran into that, and in theory the oil price should react quite strongly to that, but I don't know how much is already in.
Yeah, certainly one we'll continue to watch. We'll watch the geopolitics and we'll watch the demand story and how that plays out in commodities, in oil and the wider commodity space, which I know last week we talked a bit about, didn't we, about some of those base metals and the weakness that we were seeing there. That is it then for the opening trade. We have European stocks up by 0.4% this morning. The FTSE 100 up by 0.6%. US futures, as I mentioned a moment ago, are ticking up a little, up by 0.3% on the futures story. So we could see some upside at the start of what is a much calmer week than last week. Have a good one, everybody. The Pulse is up next. This is Bloomberg.